I'm Russell Poynter from Edison Group. Once again, it's great to have Richard Hutton, the CFO of Greggs, with us. Good morning, Richard. Thank you for taking the time.
Sure, my pleasure.
Richard, we spoke a year ago when Greggs had just completed the first year of the five-year growth plan, and obviously you've just completed the second full year. So I thought it'd be a good idea to actually just catch up on the things we spoke about previously. The first one is space growth. You've done 2 years of pretty consistent store growth now. So I was wondering whether you could just talk a bit more about what's happening to the store portfolio in terms of, the quality of the stores, and perhaps talk a bit more about the franchisees, how important they are and how that is showing up in the numbers too.
Yeah, sure. Happy to do that. We've been growing, as you say, about 150 net new shop openings each year for the past couple of years. We sensed there was an opportunity coming out of the pandemic because Greggs was well capitalized, had a very clear view of the multi-channel journey ahead, and needed a kind of a different blend of shops to achieve that. So we've been adding shops at a fair pace, taking advantage of, I think, a slightly softer market in the last couple of years. The types of shops we've been opening is different compared with the historic sort of estate setup. So more than half of our estate currently is represented in towns, cities, suburbs. I guess the places you would have expected to find a baker in the old days. That was a great strength during the pandemic, but where we're expanding now tends to be in more on-the-go locations, such as travel locations, workplaces, supermarkets, retail parks, those sort of areas. So broadly, 3/4 of our openings last year were in those sort of locations. So we are changing the mix of the estate as we go forward. We're also relocating shops, and that's an important part of the story, actually, because what we're finding is as we become more successful in the new areas and as the range is evolving to a more food-to-go offer, we need a bit more space. And some of those smaller suburban shops that perhaps were the heartland of Greggs historically are just too small to cope with the amount of growth that we've enjoyed. So relocating shops is a really important part of the story, and it plays to this theme of increasing the quality of the estate. We've been doing a lot of that in the last couple of years as opportunities have come up. You can imagine high streets are one of those areas where there is plenty of opportunity to relocate stores within the same catchment, because they're still good catchments for us. We can just do more in them. So a combination of changing the locations we trade, relocating existing shops within catchments is overall just changing the shape gradually. And it's a big estate, 2,500 shops you can't change overnight, but actually we've been doing this for more than 10 years now, altering where we trade. And just to your final point there on franchise partners do play a really important part in this because they give us access to locations that we can't otherwise trade in. So from a company managed perspective, we can't trade in motorway services, for example, and we have relatively few company managed shops in petrol forecourts. But these business to business franchise arrangements give us access to those locations. They're extremely popular with the franchisees as well. So, it is working well both ways and giving us reach into areas that we couldn't otherwise access. We do have to be slightly careful with the locations to make sure that we're not pitching against ourselves in terms of local company managed shops, but we've got a good dialogue there with the franchise partners and we make sure it works for both parties.
And the evening day part, that's becoming increasingly more important for you. And again, harking back to last year, you said one of the key challenges is changing the customer's mindset towards Greggs. So again, could you talk about the progress you've made and perhaps how you're doing relative to those expectations?
Yeah. I mean, and that is the key thing. It's a mindset change. Greggs is kind of, subconsciously we think of Greggs as somewhere you go for breakfast and lunch, and we need to, over time, raise the expectation that it's somewhere that you can go in the early evening. And we already see that in some locations where you take railway locations, for example, we are super strong all the way through the evening, and commuters running for trains seem to really sort of see Greggs as a great option for that sort of like quick to access food that you can grab on the go and eat easily on the move as well. So the question for us is, can we apply that to other customer sort of occasions? And can we change the mindset so that people do think of us when they're looking for something delivered into the home or when they're looking for somewhere to go during that early evening day part. If you look around at the moment, you'll see lots and lots of marketing from us that's really emphasizing that sort of opportunity. You'll see the themes are very much sort of evening lit themes. You'll see lots of pizza and other type products that people want to eat at that time of day, lots of hot chicken. So we have the products, we have the availability in the shops. We've been opening them later and investing in labor to make sure that the availability is there. So I think, as we said at the start of this journey, it's going to be a very gradual one. We saw growth last year in the evening day part that was the strongest growth of any day part. And I expect that that's going to be the theme, that we'll see steady growth from a low base, and over time that will accumulate in the way that it did with breakfast. So I think we're pleased with the progress we've made. We're not surprised that it hasn't just taken off, because I think that's the nature of this journey, that it's steady and it'll take a number of years.
And making better use of digital channels is a key driver too, one of which is delivery. So again, great to get your thoughts on how you've progressed over the last 12 months, and talk about Uber Eats, where you joined in the third quarter, I think. Talk about how that has changed what you're doing.
Yeah, no, that's right. We had coming out of the pandemic, we'd already agreed an exclusive arrangement with Just Eat, where we developed a successful delivery channel post-pandemic. I think what we saw in 2022, like the whole market, was that effectively that delivery channel had been inflated by the pandemic impact, and so it went backwards slightly in 2022. And then last year, the year we've just reported, was a year where we rebuilt. We became better operators in delivery and saw very good growth with Just Eat. But we also trialed to see whether going with a second aggregator was incremental. And the trials proved that actually, for us, going with Uber Eats alongside Just Eat was going to be a highly incremental addition. And so back in September, we started to roll out the Uber Eats option alongside Just Eat. What that meant was that we paid a slightly higher commission fee through the balance of the year on the Just Eat business. And so we took some margin cost through the back half of 2023, but we're now in the position where we're pushing on both fronts. So we've rolled out Uber Eats now to more than 900 shops, and Just Eat is in more than 1,300 shops, and we'll be driving both of those channels and getting the incremental benefits of both through the year ahead. So that appears to be kind of the best blend for us as we sit here now. We're still learning in this area. We're becoming better at order fulfillment, and learning about the different marketing levers that you have to pull on these channels to make them successful. So we believe there's a lot more to go. And the really important breakthrough for us would be if we could actually start to become more known for delivery in the evening as well, because currently most of our delivery business is actually in the daytime. And there's a big evening market, which Greggs is very underrepresented in. We've just talked about it. Our market share is tiny, really, in the evening. If we could get customers to understand the value that we offer on delivery in the evening, and think of us at that time of day, and there are all sorts of opportunities to try and do that, then over time I think we could have a much bigger and more successful delivery business, which would also support our evening growth ambitions.
And it's pretty clear from looking at the results that 2023 was a very good year for Greggs, certainly compared to a lot of other consumer-facing companies. So could we just step back and just give some overview of where you think market shares are at the moment, and perhaps how you finished up the year on a relative pricing perspective versus your competitors?
Yeah. So if we start with market share, it was a super successful year for Greggs. Our market share grew from 7.7% in 2022 to 8.2% in 2023. We were the fastest growing brand by volumes in the food to go out of home market, as measured by Circana. And so I think by any measure, Greggs was the highest performing brand in the sector last year. And that was driven by the many different initiatives that we've been getting behind. Pricing and the macro, I think, is also important. So it's obviously been a period where consumers have been looking to make their money go further because they've been suffering price inflation in the economy generally. And I think it's entirely logical that they would look for the best value in the market to try and sort of avoid having to curtail their demand. And I think the evidence over the last 18 months to 2 years is that we've been a beneficiary of that. Now, we've gone out and really presented ourselves as the value solution to consumers based on our pricing, but also the deeper discounts that we've offered through the loyalty app, for example, where we're effectively giving a 1 in 10 incentive for people to shop with us more often. And the combination of our basic price proposition and that loyalty incentive, I think, have been very successful in driving that market share. The pricing, I mean, everybody's had to move their prices in the last 2 years. I mean, we've all seen this. The reassuring thing is that the relativity of Greggs pricing hasn't changed versus its competitor set, and we monitor that every month. We broadly hold a position on pricing which is comparable with supermarkets for like products, but we make fresh in store. So we would argue that that's our competitive advantage in that sense. And against the food to go specialists who also make in store, we have substantially lower prices. And when we look at the indexing of those prices over the last 2 years, it has barely moved. So I think everybody in the market has behaved in a rational way, facing the same degree of cost inflation. And we've come out of it in a very similar position. And I think overall, during a period, as I say, when people were looking for value, Greggs has been an obvious place to go.
Thanks. So touched on inflation there, and obviously that was the big subject through last year for a lot of the sector. So could you just give some overview of kind of what you think about the outlook for inflation this year, and perhaps hark back to how inflation affected the various parts of the P&L last year and the catch up you've had to make?
Yeah, I mean, I'm relieved to say it's a much more stable outlook looking forward. Clearly, there are no guarantees in this world, are there? But we have a great deal more cover, which I'll come back to. I mean, the story of last year was that we saw 8.5% like-for-like cost inflation. The pattern of that was it was more like 11% in the first half and 6% in the second half. So we exited last year at more like 5% cost inflation. And coming into this year, we expect that will be somewhere between 4 and 5%. And it kind of mirrors the mood music in the economy overall, which is of an improving picture. We've got more visibility as well because we have got about 80% of our energy requirements covered this year, i.e. fixed. And we've also fixed forward about 4 months worth of our food and packaging requirements. So in terms of what could change, well, broadly, the second half of the year, there is still some exposure on the food and packaging costs, which are about a third of our cost base. The biggest element, which is labour cost, wages and salaries, are fixed in terms of the agreement for the year, and that's of our cost base. So it's really those commodity items within food and packaging that could change. At the moment, as I say, there are no obvious sort of signs of disruption, but the world changes pretty quickly and nobody knows. But I think, if it does, the evidence is that, the market, as I said earlier, has behaved rationally. And I think we're in a strong place to deal with that if we need to. We have been recovering our cost inflation successfully. And we had to take a bit of a haircut 2 years ago when costs took off very rapidly. And over the following 2 years, we will have effectively recovered that margin hit that came from that big spike in commodity costs. But as I've already said, we've managed to do that without affecting the relative competitiveness of the business.
That's great, Richard. Thank you very much for the overview and the outlook for the year. I wish you good luck for the coming 12 months.